Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at HIMS and HERS health.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And honestly, today's topic is, it's the perfect example of why we do this. We're looking at a company that is currently, I'd argue, one of the most polarizing battlegrounds in the market.
I love a good battleground stock.
Yeah.
Usually when you see that kind of split, half the market thinks it's a rocket ship, the other half thinks it's going to zero. That's where the real opportunity is.
That's exactly it. If everyone agrees, the price is efficient. No money to be made. But with HIMS and HERS, this is a company sitting at, well, a violent intersection.
A violent intersection. That sounds dramatic.
It is, though. On one side, you have this massive, just undeniably impressive fundamental growth. The numbers are staggering, frankly.
Okay.
And on the other, you have a high-stakes, headline-grabbing legal war with big pharma that has investors just, well, completely terrified. It's a classic collision.
All right. I definitely want to get into the legal drama because that sounds juicy. But let's start with the business itself, because if you asked me about HIMS and HERS, say 3 or 4 years ago, I would have said, oh, right, the guy's selling hair loss pills on Instagram.
And you wouldn't have been wrong, not back then. That was kind of the vibe.
But I'm guessing that image is a little outdated now.
Oh, completely. We need to just shatter that mental image right away. This is not some scrappy little startup anymore. They have scaled into something serious.
How serious are we talking? Give me the scale.
Okay, so let's look at the Q3 2025 revenue numbers. For that one quarter, just 3 months, they hit $598.98 million.
Wait, hold on. Nearly $600 million in 90 days.
Correct. And that isn't just a big number in a vacuum. That's up 49.2% year over year.
That is massive. I mean, usually when a company gets to that size, $500 million a quarter, the growth rate starts to slow down. Law of large numbers kicks in. You don't see 50% growth.
Exactly. They accelerated. They beat analyst expectations, and by a lot. And if you zoom out, look at the last 12 months' revenue, their LTM. They're now sitting at approximately $2 billion.
$2 billion. Okay, that's a serious empire. But I have to play the skeptic here. We see this in tech all the time, right? You can buy revenue, spend $1 on marketing to make 50 cents back. Is that what's happening? Is this profitless prosperity?
That is the pivotal question. And honestly, that was the bear case back in 2023. Critics said, sure, they're growing, but they're lighting money on fire.
Right.
But the whole story for HIMS has shifted. We're now seeing real, tangible, operational leverage.
Okay, let's pause there. Operational leverage, that's one of those MBA buzzwords. Can you break that down for us? What does it actually mean for the bank account?
Sure. In simple terms, it means for every extra dollar of revenue they bring in, their costs don't go up by $1. Their platform, their tech, the doctor network, that's all a fixed cost. It's already paid for.
So as they scale, the profit margins just expand.
Violently. The extra revenue flows straight to the bottom line. Their gross margins are now nearing 75%.
75%?
Yes. And for context, that's not healthcare provider margins. That's software company margins. SaaS-level profitability.
Because they're not building hospitals, they're building code.
Right. And crucially, their net margins, the actual profit after everything is paid, are now positive. They're at 6.05%.
6%, which I know might sound thin to some people, but on $2 billion in revenue.
It's significant cash. And you have to look at the trajectory. Just a couple years ago, those margins were negative. They were losing money. Now they flipped the switch. Their return on equity, or ROE, is a really robust 24.67%.
So fundamentally, the engine is humming. The car's fast, it's efficient, it's printing money. If I just looked at the spreadsheet, I'd say this stock has to be at an all-time high.
You would think so.
But, and here's the big but, if I pull up the chart today, February 11th, the stock's trading near $26, and its 12-month high was around 73. So we're talking about a stock that lost almost 2/3 of its value, while the business was growing 50% and turning a profit. That is a disconnect. Why?
It really comes down to one thing: fear. Specifically, the fear of the giant known as Novo Nordisk.
The company behind Ozempic and Wegovy.
The very same. The bearish sentiment is almost entirely driven by this legal war over the GLP-1 weight loss drugs.
Okay, let's unpack this. HIMS and HERS, sells weight loss shots.
They sell compounded semaglutide. And this is a key nuance. See, when there's a huge shortage of an FDA-approved drug like Wegovy, the FDA allows specialized pharmacies to make compounded versions, basically copies to meet demand.
Because everyone wanted these drugs and couldn't find them.
Exactly. It was a gold rush, and HIMS jumped on it. Huge revenue driver. But now, Novo Nordisk is fighting back with a major patent infringement lawsuit.
And nobody wants to be in a courtroom with a pharma giant. They have unlimited resources.
It's David versus Goliath, but Goliath has 1,000 lawyers. And it's not just the lawsuit, it's the regulatory heat. You know, the DOJ, the FDA, they're scrutinizing these compounded drugs. The market's fear is that this whole revenue stream is about to be shut down.
So the investors at $26 are thinking, this weight loss money, it's going to zero. Poof.
That is exactly what the price is telling us. The stock has cratered because markets hate uncertainty. The lawsuit is seeking very significant amounts in damages, and HIMS has already had to backpedal on some of their pill offerings. It looks like a retreat.
Okay, so let's play this out. Worst case scenario, the judge slams the gavel, Novo wins, HIMS can't sell semaglutide again. Is the business broken? Does it go back to being a penny stock?
And that's the nuance that the panic selling misses. The market is acting like the answer is yes, but if you actually look at the data, the answer is probably no.
Why?
Because of the ecosystem. Remember, HIMS was growing rapidly before the weight loss craze. The GLP-1s were jet fuel, sure, but the plane was already flying at altitude.
So it's a panic sell-off based on one segment of the business.
A very high-profile segment, but it ignores the moat they've built.
Okay, the moat. Let's talk about that, because the skeptic says, what moat? They're just a middleman. I can go to my doctor.
You can, but will you? Think about the friction. Taking time off work, sitting in a waiting room.
It's a huge hassle. I hate it.
Everyone hates it. HIMS is selling convenience. The moat is the direct-to-consumer platform.
I press a button on my phone, the problem gets solved.
Precisely. And once you're in that ecosystem, the switching costs are surprisingly high. Not financial costs, but mental costs. Your treatment arrives at your door every month. You have a relationship. Are you really going to cancel all that to go back to the old way?
Inertia is a powerful force. If it works, I'm not touching it.
Exactly. And they're using that inertia to diversify. It's not just weight loss. They're expanding into sexual health, dermatology, and now diagnostics. Did you see the news about the Gallery test?
I did, the multi-cancer early detection test, right?
Yes. And that's a brilliant strategic move. It's a pivot from lifestyle to clinical, from cosmetics to serious medicine.
It signals they want to be a primary health partner. It legitimizes the whole platform.
It deepens the trust. If you trust them to screen for cancer, that's a very, very sticky relationship.
Okay, so the story is, market's panicking about the lawsuit, but the company is building a diversified empire. But look, talk is cheap. Is management putting their money where their mouth is?
That is the key signal here. They aren't just talking. The board approved a $250 million share buyback program back in November.
Okay, and buyback for a growth company. That's unusual. Normally, they're hoarding cash to grow, not buying stock.
You're absolutely right. Growth companies almost never do this. It tells you two things. One, they are generating so much cash they can afford it. And two, they believe their stock, down here at $26, is irrationally cheap.
It's a vote of confidence. They're basically screaming at the market, you are wrong.
They're buying their own dollar bills for 50 cents. And they're not the only ones. We saw Principal Financial Group raise their stakes significantly just this month.
So retail investors read the headlines and sell, while institutional money is quietly buying.
That's the classic divergence. The headlines scare the tourists, but the locals are buying up the real estate.
I like that analogy. Yeah, let's get technical. Looking at the charts, is this a falling knife or is the bottom in?
It is definitely in what we call oversold territory. The chart today is ugly. I'm not going to sugarcoat it.
No sugarcoating.
No, it's trading way below the 50-day moving average, which is up at $33.30, miles below the 200-day at $43.64. The momentum is against you.
So momentum traders hate this chart. Stay away.
They hate it. But if you're a mean reversion trader, you're getting interested. When a stock stretches this far below its averages like a rubber band, it often wants to snap back.
And the valuation supports that. Is it actually cheap?
The PE ratio is around 43.5.
43 times earnings. That doesn't sound cheap on its own.
In a vacuum, no. But you have to look at the PEG ratio, price to earnings to growth. If you're growing revenue at 50%, a 43 PE is actually pretty reasonable.
Right. You're paying a premium for the engine.
Exactly. And our models suggest a move back toward $38 if the multiples just normalize. Not a crazy bull run, just a return to sanity.
So from 26 to 38, that's a healthy upside, what, 45%? But we need a catalyst, right? Something to change the story. What's next on the calendar?
Circle this date, February 23rd, 2026.
Coming up fast.
That's the Q4 and full year 2025 earnings report.
Okay, what are the expectations?
The bar is actually set pretty low. The consensus is looking for earnings per share of just 4 to 5 cents.
That seems very beatable.
It does,
Right.
and that's the setup. But honestly, the numbers might not even be the most important part of that day.
It's the commentary.
100%. Everyone will be listening to that post-earnings call for updates on the lawsuit, on the GLP-1 strategy.
They want clarity, a plan.
Exactly. If the CEO comes out and says, look, the lawsuit's a headache, but here's plan B. And by the way, our core business grew 60%. That changes the whole narrative.
Show that they're not just a weight loss stock.
Precisely. A beat on earnings plus confident guidance could spark a huge rebound because the stock is priced for absolute disaster. If the reality is just mildly annoying, the stock goes up.
Price for disaster.
Yeah.
I like that. The market's expecting the factory to burn down. If the report says, actually, it's just a leaky roof, that's incredibly bullish.
That's the essence of it. Buying when fear is at its peak.
So we've got the fundamentals, the legal storm, the technical screaming oversold, and an earnings date. Let's wrap this up. What's the Smart Wealth score?
Taking everything into account, I'm giving HIMS and HERS a bullish score of 7 out of 10.
A 7. That's pretty confident given the lawsuit. What's the final argument?
The argument is that the strong fundamentals, the revenue, the profits, the buybacks, are outweighing the near-term litigation noise. The market has overreacted.
Throwing the baby out with the bathwater.
Yeah, I think so. The strategy here sets up as a nice swing trade into earnings, but it also holds water as a multi-year hold.
Because of that personalization angle.
Yes. Personalized healthcare isn't going away. HIMS owns the customer relationship. Novo might own the patent, but HIMS owns the patient's trust, their email, and their credit card on file. That's incredibly valuable real estate.
And the price target again?
Near term, we're looking at potential upside of about 43% to get back to that $38 range.
That's a big move. And it seems like the downside is somewhat capped, just because it's been beaten down so much already.
Well, you never say never. It could go lower. But at 26, a massive amount of risk is already priced in.
What if they lose the lawsuit completely? Total defeat. Does the thesis break?
It takes a hit, for sure. The stock would probably drop maybe to $20, but remember the diversity. Hair loss, ED, mental health diagnostics, and they have that $250 million buyback to support the price. So it's painful, but I don't think it's fatal.
A setback, not a knockout.
Exactly, and the market is pricing it like a knockout right now. That's the opportunity.
So, to summarize, it's a battle between a profitable growth engine and a legal wall of fear.
That's the perfect summary. You have a Ferrari engine inside a car that's driving through a hailstorm.
And a bet on HIMS now is a bet that the car is sturdy enough to get through that storm and find the open highway.
And that management knows how to navigate, which, judging by the buyback, they seem pretty confident they can.
Right. Before we go, I want to leave everyone with a final thought. We talk a lot about products and lawsuits, but there's a bigger shift happening.
There is. We're moving away from one-size-fits-all medicine. In a world of standardized healthcare, the company that masters personalization, that owns the customer relationship, they might just win the whole war.
Even if they lose a battle with Big Pharma over one specific drug.
Exactly. Owning the patient's trust and their daily routine is the ultimate asset.
A fascinating way to look at it. Big Pharma has the patents, but HIMS has the relationship. And in the modern economy, access to the consumer. Well, that's king.
Couldn't have said it better myself.
Thanks for listening to Smart Wealth with Joshua. We'll catch you the next one.